In April 2025, global financial markets experienced an unprecedented shock when Japan executed what analysts later termed a financial strike against the United States. Without warning or public announcement, Japan liquidated $1.7 trillion in U.S. Treasury securities within a 48-hour period, the largest single-country sell-off of American debt in history. The impact was immediate and devastating. Wall Street experienced a meltdown as the Dow Jones Industrial Average plummeted 4,800 points. The Nasdaq dropped 12%, while the S&P 500 fell to levels not seen since the 2008 financial crisis, as bond yields on 10-year treasuries spiked to 6.2%. The ripple effects hit everyday Americans hard. An estimated $5 trillion in U.S. market capitalization vanished in just 3 weeks, or 47 million Americans with retirement accounts. The impact was personal and severe. Major pension funds reported losses between 15 to 20%, while higher interest rates crushed homebuyers and squeezed businesses across the country. Credit markets tightened dramatically, creating a credit crunch reminiscent of previous economic downturns, a strategic pivot years in the making. What made Japan's move particularly significant wasn't just the sell-off itself but what happened next. Rather than simply converting treasury holdings to cash, Japan executed a carefully orchestrated strategic reallocation of capital that signaled a fundamental shift in global financial alignment. Approximately $300 billion flowed into Chinese and Indian sovereign bonds, while another $200 billion was directed towards Southeast Asian infrastructure initiatives. Japan's currency reserves in yuan and rupee increased by 40%, while their USD holdings were slashed from 54% to 35% of total reserves. By the end of the first quarter, 62% of Japan-China trade had completely abandoned dollar-denominated transactions. This wasn't a temporary adjustment but rather the culmination of years of planning, a chess move on the global financial board that had been prepared long in advance. The breaking point: why Japan acted. Contrary to initial reports characterizing the move as unexpected, evidence later emerged that Japan had issued multiple warnings to Washington that went unheeded. Japanese officials had repeatedly expressed concerns about 3 major issues: American tariffs targeting Japanese electric vehicles, perceived manipulation of yen valuation, and diplomatic treatment that failed to recognize Japan's status as a major economic power. For decades, Japan had been a reliable purchaser of U.S. government debt, helping America borrow cheaply while stabilizing global markets. This financial relationship had been a cornerstone of the post-World War II alliance between the two nations. However, increasing economic tensions, particularly around tariffs that directly impacted iconic Japanese manufacturers like Toyota, Nissan, and Honda, created a breaking point. The final straw came when the Trump administration included Japanese automakers in a broader tariff package aimed at foreign threats to American industry. With no meaningful diplomatic resolution forthcoming, Tokyo made the decision to exercise its financial leverage in dramatic fashion, accelerating de-dollarization. Japan's move catalyzed an already developing trend of global de-dollarization. China, which had been gradually reducing its holdings of U.S. treasuries from $1 trillion to under $800 billion over 5 years, continued this trajectory. Russia had already largely abandoned dollar assets following earlier sanctions. What made the post-2025 period different was the breadth of participation. India, South Korea, Brazil, and the United Arab Emirates all accelerated their reserve diversification efforts. Currency swap mechanisms expanded rapidly, and reliance on USD transactions declined across multiple trading partnerships. At a G20 summit following the crisis, a proposal circulated for a new global reserve basket that would significantly reduce or potentially exclude the dollar. The composition reportedly included gold, energy assets, defense technology, and a mix of Asian and European sovereign bonds. International Monetary Fund data reported the USD's share of global reserves had fallen to 52.7%, the lowest proportion in nearly 3 decades, while yuan and yen positions increased at unprecedented rates. Parallel crisis: the US-EU trade conflict, compounding America's financial difficulties. A parallel trade conflict with the European Union intensified during this period. The Trump administration imposed a 20% tariff on European goods, citing alleged unfair trade practices. However, analysts pointed out that the administration's claim of 39% EU tariffs on U.S. goods appeared to be a mathematical misrepresentation, dividing the trade deficit by import values rather than reflecting actual tariff rates, which independent sources placed at 1 to 4.8%. The European response proved particularly damaging to American interests. Rather than implementing reciprocal tariffs that might have limited impact, the EU deployed regulatory mechanisms targeting America's most valuable sector, technology, through enhanced enforcement of data protection laws, digital services taxation, and sector-specific regulatory requirements. The EU effectively constrained major U.S. technology firms operating in European markets. The financial impact was substantial. Meta derived over 23% of its global revenue, $38.36 billion, from European operations. Google/Alphabet generated approximately $100 billion from EU/EMEA markets. Apple earned $101.3 billion, 26% of total revenue, from European consumers. These companies found themselves caught between regulatory complexity and the economic necessity of maintaining their European market presence. Policy volatility and market response. U.S. policy responses during this period were characterized by significant volatility. After initially announcing non-negotiable global tariffs, the administration abruptly postponed higher tariff rates for 90 days while maintaining a 10% baseline on most imports and a punitive 125% rate specifically targeting Chinese goods. The administration characterized these shifts as strategic negotiating tactics, but markets interpreted them as reactive policy adjustments driven by financial panic. This perception further undermined confidence in U.S. economic leadership at a critical juncture. Trading partners responded differently to American pressure. The European Union ultimately accepted a 0-for-0 negotiation framework after initial resistance. China implemented retaliatory 34% tariffs and restricted exports of rare earth materials critical to American technology and defense industries. Canada, a traditionally close ally, signaled potential redirection of its approximately 4 million barrels of daily oil exports to alternative markets if trade tensions escalated further. The domestic impact. For ordinary Americans, the combined effects of the Japan crisis and trade disputes manifested in tangible economic hardship. Consumer prices rose sharply for imported goods ranging from electronics to food products. Regional gasoline price increases of 20 to 40 cents per gallon were reported in areas like New England. Industrial workers faced particular challenges as manufacturers struggled with supply chain disruptions and increased input costs. Technology companies found key export markets restricted, while agricultural producers lost access to important foreign buyers. The retirement savings of millions of Americans suffered significant valuation declines. A new financial order. The events of 2025 didn't end American economic influence, but they fundamentally altered the structure of global finance. No single currency emerged to replace the dollar, but the system became notably more multipolar, with regional financial networks gaining prominence and the exclusive privileges once enjoyed by the US dollar significantly diminished. What became clear in the aftermath was that financial power had become the preferred weapon of nations seeking to influence global affairs in the 21st century. No missiles were launched, no troops deployed, but the financial landscape was irrevocably transformed, not through declarations or treaties, but through the quiet movement of capital across digital ledgers, reshaping the economic foundations of global power.